Burke Cashflow Investors Live, and today is Wednesday, and we do these every single Monday, Wednesday, and Friday. So make sure to join in. Make sure you invite your friends, your family, anybody who wants to learn more about real estate investing. And on these lives, we want to answer basically Q&A. If you're doing a deal, then we want to talk about that. If something else is going on that you have any questions about real estate investing, we want to address those. Having said that, we had a bunch of questions that came in. You can always send us the questions, and we are happy to address them. We'll try to address as many as possible and go from there. I know there were, in the last couple of weeks, we had actually had a couple of questions that had come in regarding buying a couple of properties. So I know this week, meaning one closed on Monday, one closed on Tuesday. One was a property that somebody just purchased in Galewood. So congratulations to you. That was a 3-unit. So that one should work out very, very well. And I know second was a flip. So congratulations to you guys, because I know one of you guys is from Mastery, and then the other person is somebody who listens to these lives. So hopefully you will invite us. Maybe we come and make a video at your property and at your success, because with the 3-unit you bought in Galewood, I think it's going to be a home run deal. I mean, that will cash flow like no tomorrow. So congratulations. Always fun to see that. Okay. So the questions that came in today. Number one question was, what are the general financing requirements for the types of loans, down payment, and terms of loans, etc., if you're buying an apartment building? So this is a bigger question in terms of what are the types of loans that are available for that. So I want to kind of just explain what are the types of loans. So anytime you're buying more than 5 units, you are considered into not just a commercial loan, but it's basically for commercial purposes. And so then there are certain banks that you have to go to be able to get these loans. So there are going to be different types of loans. I mean, you can get so I'm just going to kind of give you guys, because this is a very extensive subject, big topic. So I want to give you an overall idea. So generally, whenever you are financing these, so the size of these loans is going to be somewhere from 1 million generally up to 50 million, right? You're going to get an LTV on these loans of about loan to value. So let's just say you're buying a building for 5 million. You're going to have to basically come out of pocket with about 20-25%. Generally, it's going to be 25%. If you have a lot of experience, it may be a little bit less, and depending on the bank you go to. So generally, your LTV is going to be about 75%. So you're going to have to basically come up with, for 5 million, you're going to have to basically come up with 25% of that, right? And then you have to also consider, are they going to finance the repairs? So, for example, let's say you're buying a property, and let's make simple numbers. You're buying the property for $1 million, right? And then you're going to need about another $1 million in repairs, because it really is a huge value add. So then you're going to have to look at, okay, how much is the down payment that I need to come up with? So on $2 million, right? They're going to look at loan to value. So, and a lot of that, and then there's another thing they look at, which is called loan to cost, meaning how much is it going to cost you to basically do the rehab. And these are two different things. So when you buy the property, they're going to do an appraisal on a commercial building, which they're going to do an appraisal of it as is value, meaning what is the value today of this particular building. And then what is the after repair value? Now, after repair value is going to be a little bit of a guesstimate. So they're going to extrapolate a after repair value. No different than in the residential world. Here in the commercial world, it's all going to be based on what is your cash flow expected to be, right? So because when you're buying a building more than 5 units, it's purely based on what is the cash. It is not the comps. Whenever you buy a smaller property, less than 5, it's based on what is selling in the neighborhood. That's what it's based on. With a building that is a more than 5 units, it's based on the performance of the building. And think about this. If you're buying a business, right? How much cash flow does it make? What's the net operating income on that property is what you will look at, because basically you're saying, okay, this business makes, let's just say 100,000. What multiple of that am I going to pay for that business? It's similar sort of thing for buying a multi-unit. So your terms are going to be size of the loan from 1 million to 50 million. If you're buying the building for, say, for $1 million and you're going to put another $1 million into it, then you may have to come up with, say, 25%. So 25%, $2 million, because you need $1 million to buy it, and then you need another $1 million to go ahead and do the rehab. So of $2 million, you may have to come up with about 25%. So in that case, it may be about somewhere around $400,000 to $500,000, depending on what is your history, who's the bank, how much you rehab, all those types of things. The next thing is they're going to look at something which is called DSCR, right? That's a ratio that they look at. Generally, they're going to require a DSCR on a building like that of 1.2%. Right? That's the DSCR ratio they're going to look for. Generally, the term they can give you is up to 30 years. And that, why do I say up to 30 years? Because that's going to depend on the bank generally, right? Who is the lender? What is their terms? Some of the commercial lenders only do a 25-year term, and they will do a 5-year balloon or a 7-year balloon. So that's something that that is there. Amortization also, again, depends on who the bank is that you go through, but in the same thing, up to 30 years. Up to meaning some banks will want to basically amortize the property in 25 years because that's the term of the loan. So it depends on who the end lender is, but those are the terms in general. The next thing is you can, as far as the rates can be a variable rate. It may be an interest-only rate. It may be basically, pegged to kind of what the, I'm just forgetting the term right now is. So it's indexed to the market, basically, is what it is. So it's 1 point over whatever the market index is, and I'm just completely drawing a blank on that word right now. But I'll think about it as we talk more. Then the second type of loan you have to think about is what is called a CMBS loan for multifamily properties, right? So that is also a good option. And then in that, you're going to have a minimum loan amount of $2 million or more. If you're going to go to a CMBS type of lender, generally these are going to be some sort of a conduit lender, right? And they're going to be somewhat more flexible in terms of their lending criteria. And this is going to be based on your net worth, and it's going to be based on your borrowing ability, right? So that's kind of what it's going to be. Often, the conduit lenders will approve the loan with the net worth as little as 25 to 40% of the total loan amount. So, for example, let's say I'm buying a building and I'm buying the building for $25 million, right? They're going to say, hey, Andrew, what is your net worth? Right? And based on your net worth, which is assets minus liabilities, what is your net worth? So they're going to make you do, obviously, not only a personal financial statement, but a business financial statement. And they're going to look at the total numbers. Based on that, they may say, well, you have a net worth of $1 million, $4 million, $8 million, whatever your number is. Based on that, they're going to say, hey, you are a borrower that has a large enough net worth. So now we're willing to take that into consideration, and we're willing to be more flexible on our terms. So that's kind of what it is. And these are lenders that will massage it based on how many properties you own, based on how long you've been doing this, and also that if it's a CMBS loan, it may be fully non-recourse with a what is called a bad boy carve-out clause, right? Meaning that if, let's just say, if I borrow a loan, right? I'm buying a bigger building and I borrow a $15 million loan. Okay, fine. But then what they're going to say is, I'm like, hey, I want a non-recourse loan, meaning that I don't, in case something goes wrong, then I don't personally want to be on the hook. It's LLC signing for it, and I'm signing on behalf of the LLC, and I am not the personal guarantor. In regular loans, even if you're buying a property in an LLC, I am going to end up being a personal guarantor. Like, say, this building, the office building that we have, right? I think we have a couple, we bought it for maybe a couple million, 1.8, 1.9, something like that. And it's an SBA loan. So even though it is in a company, right, even though it's not in my personal name, it's a business that is borrowing the money. But still, at the end of the day, guess who's on the hook? I had to personally sign for it, right? So for some reason, if somebody doesn't make the payments on it, guess what? My neck is on the line, even though I'm signing on the behalf of the LLC. With these types of loans, you have that. So that is called, whenever I'm on the hook, that I have personally guaranteed the loan, that means it's a recourse loan, meaning they have a recourse against you. Now, a non-recourse loan means that there is no recourse against me personally, right? So if the property goes, business goes bad, something happens with the property, then I'm not personally liable. The business by itself is liable, but it has what is called a bad boy carve-out, which is that the owner or the person who is basically the operator of the business is not going to just basically purposely make the business go defunct, take all the money out of it, and they say, oops, I'm going to declare bankruptcy, right? That's called a bad boy clause. So they put bad boy clauses in there because people in the past have committed fraud, they've done the wrong things with it, and that's why it's there, that these loans are not for you to do a non-recourse loan and then just behave poorly or behave badly. Generally, the number is going to be about 2 million or more. Loan terms are maybe 5 years, 7 years, 10 years, and the rates are going to be variable. And they will do a lot of different things. They will do senior living, they'll do industrial, they'll do student housing, hospitality, mixed use, mobile home parks, all kinds of stuff, parking lots, self-storage, right? That'll all come under that particular type of situation. Now, as far as prepayments, right, there may be some sort of a yield curve generally that the lender is trying to meet, but again, they're going to be much more flexible on these types of properties. Generally, the DSCR, again, is going to be anywhere from 75 to 80%. There's flexibility based on your net worth, like we said. When we look at the DSCR, that's going to be about 1.2. So that's a general rule of thumb. Amortization can be anywhere from 20 years to 30 years, depending on the bank. And the debt yield on at minimum right now, about 8.7 is what is reporting. So requires replacement reserves, right? It requires taxes. It requires leasing costs, commissions, property, liability insurance, all the standard stuff. Now, if we go to the third category, it's going to be your Fannie and multifamily, Fannie Mae loans for multifamily. That's going to be anywhere from $1 million plus all the way up to $100 million. Now you're in the big boy category, right? So when we're looking at that, again, this is basically just more advanced type of a thing. The loan terms are fairly similar with Fannie and Freddie. So there is a Fannie loan and there is a Freddie Mac loan. Also, again, the terms are going to be anywhere from 1 million plus. Then you get into a category of what we call, if you're buying a smaller property, like a lot of times people will go to, and this is going to be the last category, that's going to be your hard money, right? Hard money lenders you're going to go to, and this generally is going to be fairly easy to get this loan, but the interest rate and the origination fees on a hard money loan is going to be higher than the rest of the loans. The other loans are generally on a little bit bigger properties. Generally, I'm saying, not always, generally on a little bit bigger properties. And you have to fill out more paperwork, your qualifications are higher, but then your fees and interest rate and all that kind of stuff is going to be lower. With hard money, they're going to be a little bit more flexible in terms of terms. They're not going to put you in as through much of a scrutiny, and the size of the loan can be anywhere from 100,000 to 5 million or so generally, where hard money will operate. The maximum LTV, this is going to depend. In terms of, are you going to, depends on what is the condition of the property. I've seen them go as low as 55% LTV on the front end. We're not talking about the back end refinance. We're talking about front end when you buy the property. all the way up to 85-90%, depending on how well you're qualified and whether you have a relationship with them. Generally, the loan terms on something like this is going to be 6 months to 36 months. Generally, it's used to stabilize the property. Then you go into a little bit of a long-term loan. Interest rates all the way from about, right now, about 9.5, 10, all the way up to 20, depending on what it is. Origination fees, anywhere from minimum of 2 points, most of the cases, all the way up to 4 or 5 points, depending on how many kind of layers are in between and what is the circumstance. You may have fixed rates, you may have variable rates, or you may have index rates. So it just depends on what the situation is. So it's a huge, huge, huge topic. To really delve into it in detail will take a lot of time, so I'm not going to go into it for today. Next thing, how do I handle a bad contractor? So there were 2 questions regarding this. Number one, guys, this is going to happen to you. It's happened to us. It happens, right? It's the nature of doing business. But please understand, before you have a bad contractor, you have to put in yourself in a situation where you have this situation, right? So I just literally, there's a video that's going to be coming out. I just came from a property today where somebody supposedly has spent $40,000, $50,000. I have no idea where the hell they've spent that money. I have no clue, right? Clearly, it's not been spent on the property, clearly, right? Because the lender lent somewhere around, I think, $180,000, and supposedly there were about $40,000, $50,000 in funds that were lent for rehab. And when I went to the property, I'm like, I don't know what this is, right? I don't know where the money is. I have no clue, right, where the money is. They literally took the money for the rehab and basically paid the lender. But that's neither here nor there. But what did happen with that property is they've paid their contractor $35,000, $40,000 at least. And clearly the work has not been done, right? And so the first thing I would suggest is this, that if a contractor is going bad, please, please, please stop paying them. Please, I hope you did not pay them up front, right, for any of the work that was done, because that money is gone, right? And then if they're not going your way, then you are better off firing them and basically getting a different contractor, because if they do the work halfway, now you're going to have an issue, because you're going to have to start all over anyways, and then they may demand payment. So if there's already work has been done and it has been poorly done, you're better off cut your ties as quickly as possible and move on. Now, let's just say the contractor says, hey, you haven't paid me and there's a dispute, right? I would rather try to engage with them, right, and talk to them and try to see if you can resolve the issue. If possible, right, try not to get it to such a big issue that there's a lien recorded. If there is a lien recorded, if they do record a lien against your property, it is not something that you have to be afraid of. Any lien that is less than $10,000, any lien that is less than $10,000 mechanics lien, you can go to small claims court. It costs about $400, and you can present your case, and you don't need an attorney. You don't need anybody for that, right? In small claims court, less than $10,000, there's no reason to have an attorney. They're not allowed anyways, because it's supposed to be a small claims court between 2 people. Just please understand, like any other lawsuit, he who has the best records will win, right? So if you kept a record that, hey, I called you this day, I texted you this day, I sent you an email, right? Always, if you leave a message for somebody, then, and if you text them and then email them, always memorialize that, hey, John, I tried to call you, you didn't pick up. Then I tried to leave you a message, your voicemail was full, whatever the case is. Otherwise, I left a message. I texted you, and I'm sending you an email. And let's just say they haven't responded. It happens, right? Then I would put in there, hey, I've been trying to reach you. And I would build a case history, because that case history will become very important. Johnny comes back and says, oh my God, Andrew didn't pay me, right? I've been doing all this work, Judge. He doesn't pay me. Now, if only message he has on his answering machine is, oh, you asshole, right? And you're basically cursing the person out, and he plays that in front of the judge, that, look, this is the type of person this human being is. Guess what? The judge doesn't know you called him 50 times. They're not going to believe it. But if you have a call log, if you have emails, say, hey, judge, listen, I've sent 10 emails. On the 12th one, after this person has been taking advantage of me, yes, I called him a 4-letter word, right? It's fine. Why? Because they understand that it is a consistency consistently you've tried to work with them, you've tried to respond to them, you've tried to cajole them into getting your job done, and they're still not doing it. Now, if you go off on them, then in court, you're like, okay, yeah, this is a valid reason. But if you just seem like a whack job and you just start going nuts on them, and that's all that the court has evidence of, right? Then guess what's going to happen? Then you're going to be looked like as you're the person who's trying to put the screws to the contractor. So always, if there's any issue going on, always leave a message, try to. Then you memorialize that with a text. Hey, this is Andrew. Johnny, I've been trying to get hold of you. Hope everything's okay. That's where I would start. And then memorialize that with an email follow-up, right? And just basically just keep a track of it. I called this time, I did this, and I did this. And you memorialize that, so now you have that email and you have the record of the texts so that it's not going to be an issue. If you have that generally in court, you're going to come ahead and you may owe them $1,000 or $2,000 if they can prove they actually did the work, but generally the judge will favor with you. If you say, well, nothing was done or only this much was done, and they say, no, I did 10,000. Just understand, in a small claims court, generally what they're going to do is they're going to take the total amount asked for versus what you're saying, and generally they're going to split it in half, right? That's just how it works. So, but the more proof that you have, the better off you're going to be. The other part of it is that let's just say they do record a lien on your property, right? If they do record a lien on your property, is that the end of the world? No, it's not, right? So let me explain what happens. Let's just say somebody records a lien and they claim to say, well, I did 8,000 work. They go record a mechanics lien. Now you're going to do a flip. Okay. So let's just say they won't release it and you're doing the flip. What's going to happen is of the $8,000 lien that they recorded, generally a time and a half. So about $12,000, let's say Fidelity is doing your closing, they'll put that aside, right? They're not going to give you that money, but after a year, they will release that money unless the contractor has done a prove up, which is they have basically taken you to court and then they have prove the case in court that, hey, this mechanics lien has been proved up, right? So otherwise, it's just a mechanics lien. After a year, if they haven't done anything with it, you're going to send them a notice and then it will fall off. Otherwise, if you're basically dealing with it before that, one is you can negotiate with them. Number two is that they will put that money aside. Same thing with the refinance is they'll hold that money aside. Fidelity will, and then it will get released after a year. I know that is something that nobody wants, right? You don't want your money to be stuck there with Fidelity. But please, what you should not be doing is just because somebody says, oh, I'm going to record a lien, don't just get threatened and don't just go ahead and pay them because you think that they're going to record a lien and your life is over. Your life is not over, right? And if you have any further questions, please talk to us. At that point, this whole situation about contractors done bad work, we could go on and on and on about this, but I mean, this is just me. If I'm getting a roof on the property, I'm happy to sign a contract. If I'm getting something else done in a property, which is a bigger part of the job, that's fine. I do not sign contracts with the rehabbers inside the property. Right? People who do jack of all trades, people who are going to do cleanup, people who are going to do some drywall, some patching, some installing installing cabinets, installing trim, installing doors, all that kind of stuff. I do not sign a contract with them at all. Now, I'm not saying you shouldn't do it either, but the problem is this with signing contracts with contractors. If a contractor is not an honest person, and not all contractors are that way. There's some wonderful, wonderful contractors that we know that we work with. They are fantastic, right? But I'm just saying, if you sign a contract with somebody who's unethical, the only person that has anything to lose is you, right? That's like a lock and a thief. Well, guess what, right? Locks are made for normal people. They're not made for thieves because they're going to break in, they're going to break in, right? And with a contract, a lot of times, a contract can work against you. Right? People think the bigger, the more long drawn out contract, the better you're protected. You're actually not. Because if it ends up in a lawsuit, now your attorney's got to interpret a 20-page contract, 30-page contract, and now they'll go word by word as to what did each line mean. So I don't sign any contracts. Now, if I'm going to have a new garage built, right? So Danley Garages, let's say in Chicago, or there's a roofing company that I know, with them, I'll sign a contract because I don't want liability of somebody being on my roof. Also, I'm going to have them name me, my LLC, as additionally insured. It doesn't cost them a dime, but then if somebody falls off my roof, I'm additionally insured under their insurance, under the roofer's insurance. So in that case, it makes sense to have a contract. But with general people that I'm hiring to do some of the basic job functions in a property, I am not going to sign a contract, and I'm certainly not going to sign this big detailed list of all the scope of work that needs to be done, right? The reason I don't do it is because the longer the checklist that you have to do this, each time they make any tweak, any change, it becomes a change order. Now you're going to pay much, much more for every change order on a property. So just something to think about. And this is a big thing. If you are having a problem with a contractor, please reach out to us. We will do everything possible to try to be of help to you, because this topic can go on and on. The next thing is, as an entrepreneur or investor, we're able to legally write off a lot of expenses, and therefore we can honestly report very low taxable income. That's correct. Minimize our taxes. What is the taxable income that you typically report on your tax return as an investor? So it depends on, this is an open question, because if you're doing a lot of flips and you're making, let's just say you're doing a lot of flips, you made last year $300,000, any expenses that are related to the flip, right? Meaning to operate your business, maybe your vehicle, maybe your home office, whatever it is, that you can write off. That makes sense, right? Paper you bought, stationery you bought, computers you bought, right? All that kind of stuff. Like, I mean, if you look at us as a business, right? I mean, we buy a lot of equipment. We have lots and lots of computers at the office, 10, 15 computers at the office. So any of that expense, any papers, this, that, it doesn't even matter. Even if we have a mastery party going on and we bought all this food, all this booze, that's a legitimate business expense. That's not, I'm not taking that at my house, right? That is purely for business. It's for clients. So any of that stuff, all the stuff that we have in the office, as long as it used for business purposes, meaning making more revenue or servicing our client and or potential client, every single thing is related to a business expense, because that's what it's genuinely for. So you can write that off legitimately, right? But if that is not the case, right? If you're not using it for your business purposes, then you cannot write it off. So if you're doing flips and you're doing a bunch of flips and you made, let's say, $300,000 doing flips, then you're going to take the $300,000, subtract all your expense structure against it, and the rest of the income you're going to pay tax on. Now, if you are doing, say, flips and you'd have a W-2, so let's just say your W-2 is $150,000. You made another $150,000 doing flips. You're going to pay taxes, whatever normal deductions you're going to get on your W-2 side of it. You're going to try to write off as much as possible, but then the rest of it, you're going to have to pay normal income tax on it. Now, what if you're doing a bunch of flips? You have a good job, and then you have a bunch of rentals, right? So if you have a lot of rental properties and you have significant income from your job, significant income from your flips, and significant income from your rentals, what you're going to try to do is that you're going to take basically a depreciation schedule against your rental properties. So let's say for the year, you have let's say $100,000 in rental income, meaning after principal, interest, taxes, insurance, any other management costs, any other costs that are rental related costs, repairs, so on and so forth. So after that, you made $100,000, right? You own 10 properties. So the way it'll work is that you take $100,000, you own 10 properties, so we're going to put a value on each property. So let's say across the board, your all-in cost on the properties is $200,000 a piece. And then the land value on it is $50,000. So you take $50,000 out, so $500,000 is gone. $200,000, so 150 times 10 is going to be $1.5 million. Now you're going to take $1.5 million, you're going to divide it by 27.3, and then that number. So basically that will be, I'll tell you what the number is. 27.5. So that number is 54,000. So the way it'll work is you have 100,000 that you made net profit from your rentals. minus you're doing a straight depreciation on a straight schedule, which is $54,054, 54545, right? $54,545 you're going to be able to write off. So on 100,000, you're going to subtract 54,000 out of it, and you're going to pay income on the leftover money. Plus, you're going to have to add the net profit from your flipping. Plus, you're going to have to add personal income, and that's what you're going to pay tax on. Now, you have a second category you can go to where you start doing accelerated depreciation. So let's say I have the same 10 rental properties, right? And value out of it. And then I start depreciating, let's say, how about the TV, since I'm using it for business? How about the carpet? How about all the stuff how about the windows? How about the roof? How about the stuff? All these things. That's called an accelerated depreciation schedule. The IRS allows for that. You have to get in, there's engineering firms that figure out what that accelerated depreciation schedule is. Cost of it is a little bit, but you get significant tax advantages if you do that. Now, instead of having $54,000 for you to pay taxes on, 100 minus 54, the rest of it you're going to pay taxes on. So instead of paying taxes on that, now because of the accelerated depreciation, you may get 75 or 80,000 offset so that you can have more tax savings. So on paper, you're basically paying less, you're paying taxes on less money on paper. That's how that works. So this idea, a lot of times people have that, well, as an entrepreneur, as an investor, I can just write everything off. No, that's not how it works. You can write everything off. That is for the purpose of running a business. Your interest, obviously, you can write off. Your depreciation you can take if you own loads of real estate. So that's how that kind of works. I mean, same thing like your car. If you're using the car for the purpose of business, and let's just say you have a 90-10 use, 10% is for personal, 90% is for business. So even if you have a fancy car and you are a content creator and a car is a part of your content creation, which is you're showing your success, whatever the case may be, right? Then guess what? That is going to be completely written off. If I buy an airplane and I'm using the airplane for travel back and forth to Florida, back and forth to our different investments, or even if we have a business retreat and we're taking staff on the airplane, it is a legitimate business expense, right? So then 100% of that is offset against whatever the yearly income is for that particular year. So that's how that sort of a thing works. How do you buy so many properties? Next question. Rental properties in 1 year. How do you consistently get loans for the next property renovations if you haven't had property long enough to show the bank a year of cash flow? So great question. It's a wonderful question. Keep these types of questions coming. So this is simple. How do you buy so many rental properties a year? How do you consistently get loans for the next property and the renovation if you haven't had the property long enough to show the bank a cash flow? So the way we buy a lot of properties is three different ways. Number one, that you have to have cash. That's one, right? So either you earned the cash, you earned it something else, you got it from your family, you got it from somebody. That's one, right? Now, most of us didn't start out that way. I started with a $20,000 home equity loan on my townhouse at the time when I first bought a investment property, 2008. That's how I started. Now, obviously, I have much more earned cash. So now I can buy a lot of properties for cash, but that's not where majority of the properties come from. I use the cash to buy. I use the second place I use loans is I use what is called private money loans. So if you've registered for the 3-day, you will see that there'll be tons and tons of private money lenders that will be there from Mastery that do loans to brand new people, just like you, just like I was at one point. So that's the second way how I buy the property on the front end. Front end meaning when I'm buying the property either to flip, or if I'm buying the property to keep it as an Airbnb, or I'm buying the property to keep it as a long-term rental. So this is front end meaning when I'm buying it, then I'm fixing it. I'm fixing it with the private money also. And then I'm going to refinance the property to keep that property for a long term if I intend not to sell it. So, and the third way of buying the property is with what is called hard money. In that case, I'm going to have to put about 10% down, and then the rest of it, the hard money commercial company, they're going to provide the rest of the loan. So then once the property is bought, and if I intend to keep the property, the way we scale, and they don't look at your cash flow. The question you asked is very solid question that, hey, I don't even have cash flow. I just bought the property in January, man. I got it fixed in February, March. By April, the property was rented. I don't even have a cash flow yet because it just got rented. So whenever these commercial lenders are giving you a loan, it is not based on your past year's performance. It is based on a lease that was signed right away. Or if it's new construction, they don't even need a lease because they know you just got the construction done. It's going to come on the market. So, and you're going to lease it out. So they're giving you a loan based on a potential lease you're going to get, or based on a lease that you may have just put in place, and then you're scaling. So you're not buying these properties. If you want to build scale, you're generally not buying these properties in your personal name. You're generally buying these properties per LLC. So we buy 5 properties per LLC. So this is something important that you have to consider and you have to think about. The next thing is that it is not based on what your personal income is, right? That's the other thing to remember, because people are like, but Andrew, it's okay for you, but I may be able to buy 1 or 2, and then my personal income is not going to qualify, which is fine. It's not based on your personal income. It's based on the income that is created by the rental properties. So then you don't have to worry about it. And it's also based on a potential income that's going to come in the next month, right? So all of these commercial loans are based on the performance of the property and not you. And it's based on the future performance of the property, not even the past performance of the property. So that's the reason why we're able to scale and why we're able to grow at a very rapid pace. Great questions today. Loved it. Please keep the questions coming. We're super thrilled, guys. The 3-day is coming up on the 16th of next month, on February 16th, 17th, and 18th. If you haven't registered, make sure you register. We're growing. I mean, we are growing at a phenomenal pace. You will start seeing a lot of social media, a lot of content that is coming from our end. And this is a big push we're doing. We're hiring more people. We are going to grow. The question is, are you? Are you coming with us? If you are, let's go. I know Mastery has been absolutely bonkers. The amount of properties people have bought in the last just 2-3 months. All people are brand new from Mastery. So the market is ripe. The market is good. And the future is bright in terms of flips, in terms of rental properties. So the question is, are you on board? If you are, make sure go to andrewholmesevents.com, register. Again, that's andrewholmesevents.com. Register. If you're bringing a friend, you're bringing a spouse, you're bringing somebody else with you, we will give you a complimentary ticket. And especially if you're coming as a VIP, register as a VIP, because that's where you're going to maximize the benefit. The point of going to the 3-day is not just seeing, oh my God, what's going on in the market, but for you to make actual contacts with people that you can borrow money from, that you can find deals with, that will help you sell the house property, that'll rehabbers that are in the market, and they're all going to be Chicago investors. This is number 29, right? And we are growing leaps and bounds. So come with us. Let's build this real estate thing together. Talk to you soon.